Hey guys, a very good morning and welcome to a new episode of the Trading Academy. So in today's episode, I'm going to explain to you guys everything I know and everything that you need to know about channels and wedges, how to draw them in and how to trade them profitably. So with that said, let's dive straight in. So we're going to start off by making a distinction, and that is going to be the distinction between ascending price action and descending price action. So on the left over here, we have the ascending price action. And what is ascending price action, you may ask? Well, ascending price action is price action that is rising in towards the highs, going up. On the other hand, we have descending price action. And sorry for my handwriting, but I'm not the best. And on the other side, we have descending price action, and that is price action that is moving down in towards the lows. Yeah. So the first distinction that you have to make is the fact that ascending price action is a sign of potential bearishness to come, and that descending price action is a sign of potential bullishness to come. So keep that in mind. And with that said, we're going to head over now to the actual channels and wedges. So as we know, and I need to delete the arrow, ascending price action is a sign of bearishness to come. So we have two types of price patterns, and this is a channel. So a channel has equal highs, equal lows, and what you'll see is that the lines are very symmetrical to one another, and it is drawn in like this. And then boom. So after that ascending price action in towards the highs, we see descending price action back in towards the lows. So that is the first one. We have the channel. And then second of all, we have the wedge. And the wedge formation is more of a squeezing formation. And that looks like this. At first, the difference between, or the distance between the high and the low, pretty large. And the further you come in towards the channel, the more the highs and the lows come closer to one another. And you'll really see a price squeeze in towards the wedge before breaking out back down towards the downside. And once again, we have ascending price action, prices moving in towards the highs before then crashing down, back down in towards the lows. So keep that in mind. And with that said, we're going to head over to descending price action. And descending price action is once again a channel, which is symmetrical lines with equal highs, equal lows. Or the distance between the highs is very equal and the distance between the lows is preferably also very equal. And what we'll see, I have to draw it in a descending manner, is that price comes in towards the channel with a 1, 2, 3, and then boom, move back up in towards the high. So that's the channel. And then we have the wedge, and the wedge is like this. Once again, at first, the distance between the high and the low is pretty far. And the further you come in towards the pattern, the more of a squeezing formation you'll see before breaking back up in towards the highs. So I hope that's clear. And with that said, we're now going to dive deeper in towards the technical parts of a channel and a wedge. And the main technical that you have to understand is that a channel or a wedge will always have to consist of 3 highs or 3 lows. So what does that mean? Well, we have a 1, a 2, a 3 before moving up in towards the highs. Once again, with a wedge, you have also a 1, a 2, a 3 before you should be moving back up in towards the highs. So this fourth touch, you can neglect that one. Just have to remember that you have the 1, the 2, and then the third trendline touch before moving back up in towards the highs. For ascending channels and wedges, you have the exact same rule. You have the 1, the 2, the 3 before moving back down in towards the lows, with an ascending channel as well. 1, 2, 3 before moving back down in towards the lows. So with that in mind, you now know the basic rule of ascending channels, ascending wedges, and descending channels and descending wedges. One more rule. There is always an exception. And that main exception is that if you see a fake out on the second high or on the second low. So that is another possibility. So what do I mean by that? Well, if we have an ascending channel like this, we know, okay, we have our 1 and our second trendline touch. So now potentially you're going to be waiting for that third trendline touch, right? Up above over here. However, that does not need to happen, because there is one exception, and that exception on that rule is the fact that if you see a fake out on the second high, it is already enough to expect a drop. And this is also the same for a descending channel and a descending wedge. If we see descending price action, all you need is a fake out on that second low. So yeah, with that said, I hope you guys now understand all the rules and the basics of channels and wedges, and now it's just time to dive into some charts and have a look. So at first, I've got some charts over here on the DXY for you, and we're just gonna have a look and draw in some channels and wedges and show you guys how they mature and how it really works and comes together. So in this specific situation, I have, for instance, drawn out one over here. So over here, what you have is a descending wedge. So as we can see, the distance between this high and this low is pretty far. Then the distance between this high and this low is closer. And then what you can see is that the distance between, let's say, this high and this low is pretty close, right? So you'll really see that price comes into the wedge and then starts squeezing before boom, popping up back up towards the upside. And in a bigger format, what you'll see is that once again, over here, if you draw the line from here to here, you'll see that you have the 1 and the 1, that the distance is quite larger between the high and the low. Then the distance between this high and this low is less far. And then the distance between this high and this low is even closer. So you really see that price comes in towards the wedge, kind of gets squeezed in towards the lows before boom, popping up all the way back towards the upside. So these channels and wedges are the ideal format or the ideal strategy to use when looking for trend reversals and looking for large movements to come within the market. So now looking for an ascending example, we can then identify a ascending example over here, for instance, and I'll show you guys where. Over here. So what we have over here is an ascending channel, and what you'll see is that we have the 1, the 2, the 1, the 2. You can see this as one touch, and then what you'll have, remember the exception rule, you have a fake out on that second high, and from there start dropping back down in towards the lows. So now let's look for a ascending wedge. And a good example is, let's say, over here. From here like this, from here like this. And once again, what you'll see is that price comes in towards the wedge. Then the distance between this high and this low is pretty far. Then the distance between this high and this low is closer. And then you really start squeezing in towards the highs. And then boom, that massive drop back down in towards the lows. Then what you can see is that you have the 1, the 2, and then the third trendline touch before tanking back down in towards lows and seeing that full-blown trend reversal all the way towards the downside. Yeah? So I hope you guys found this video pretty interesting. I hope you guys were able to learn some new concepts and that you will be able to apply this to your own trading strategy. So if you have any questions whatsoever, make sure to contact me through Discord. Links in the description down below. Yeah, I hope you guys enjoyed once again, and I can't wait to see you all within the Discord community. Thanks, guys.